Hello and welcome back to the channel. My name is Zach Collins and this is Financial Education. Today I'm going to be talking about negative gearing. Now I'm sure this is something that everyone watching has heard of before, and a lot of people put a negative connotation to it. Every tax system is different. Wherever you live in the world, it's very important that you know and understand the intricacies of a specific tax jurisdiction, because there are a lot of ways that you can save money on tax that are 100% legal and legit. You just need to know about it to actually make use of it. Negative gearing is one of these. Firstly, if you've never heard of negative gearing, what is it? The basics of negative gearing is that you make an investment using debt that you then lose money on. Now, this can be a small amount or a large amount. It really depends a lot on what you invest in and how. And with this loss, you use it to offset any other income you have, which reduces the amount of tax you have to pay. This might sound like taking advantage of the tax system, but it's just using the basic tax rules that everyone can use and basically multiplying it. You can negative gear any type of investment. It's mostly focused on property today because that's how most people do it. But do take note that it can be done with any type of investment. The same principles apply. I think I've said this in previous videos, but everyone is allowed to claim a deduction for expenses that occurred in the process of producing income. This is key. You can only claim deductions for expenses if you're trying to create income. If you buy land, for example, and plan to sell that land in 10 years' time, hoping for capital appreciation, you can't claim the ongoing expenses for this investment on your annual tax. Any costs that you do incur would be added to the cost base of the asset. This would reduce future capital gains tax, but it's not something you can deduct in the short term. If you took that same piece of land and use it for farming, or if you had a house on it which you rented out, this is done in the pursuit of earning income. This means you can deduct any expenses you incur on this investment from the income that it generates. One thing that is particular for property, both residential and commercial, is that you're allowed to claim depreciation on those assets. If you bought shares, let's just say CommBank, for example, this doesn't depreciate. They may have some offices they own and they depreciate those assets. This affects their balance sheet, but it's not something that you can claim yourself. Property is the one difference. This is one of the key things that investors look for when they purchase some types of properties. You need to add up all your expenses for an investment property. This could be agent fees for the real estate agent, leasing out your property, land tax, water rates, insurances like building insurance, landlord insurance, interest expenses for the loan, depreciation on the building, and if it's new, not secondhand, you can claim depreciation on plant and equipment. This is stuff like taps and kitchenware, air conditioning units, etc. Plant and equipment is not a deductible, depreciable expense on your income if it is second-hand. Regardless of whether you have a lot of income or a small amount of income from this investment, the full amount of deductible expenses can be added to your income. There is a small caveat to this though. The income you earn must be at commercial arm's length rates. So if the investment is a residential property and you rent it out to a cousin, for example, at a very low rate, you're not allowed to negatively gear that investment. You're only given a deduction such that the income is offset by the deduction. So for example, let's say this cousin paid you $5 in income, but the property had $10,000 of deductible expenses. It means you can only deduct $5,000, so the income and expense is equal as the transaction is not arm's length. If you'd rent it out to a cousin and you charge them market rate, however, then you'll still be able to deduct the full $10,000 of expenses. And you're not penalized for actually renting out to your family as long as it's done at an arm's length transaction. Now let's come to the income side of things. The majority of investments produce income of some sort. Property generates in the form of rental income, shares in the form of dividends, and bond/savings accounts in the form of interest income. As I mentioned briefly, if you want a negative gear investment, you need to firstly be earning income. This means stuff like land banking or high-tech growth stocks that don't pay a dividend would not be able to be negatively geared. You can still get a deduction in the future as this cost gets added to the cost base and it reduces your future CGT when you sell. The second part is that it needs to be income earned at market rates. As I said, if you rent it to your cousin, if you charge them less than the market rate, you need to zero out the income and deductions. Now, many US companies pay a really low dividend unless you have hundreds of billions of dollars, even trillions. You won't be the one controlling the company. This means you can't actually control how much or how little they pay out in dividends. Given that, you can fully negative gear a low income investment such as that one because it's still paying out income and it is at a market rate. Negative gearing gives a connotation that you're getting a negative return. In the short term, you are. Longer term, it really can depend. The next step in the process is you take your income whatever amount it is that you've earned, and you take away all the allowable deductions. If you have a positive number resulting from this, technically you're actually positively geared, and you have to pay income tax on that amount. Now, that amount you pay will be based on your marginal tax rate. If your normal day job is $50,000, for example, and you have a positively geared investment making you $5,000 a year, you'll get taxed as though throughout the financial year you earned $55,000. The opposite happens when you have a negative number. This is what's called negative gearing. If your income less deductions from the investment is say negative $5,000, using the same $50,000 of income above, you can use this $5,000 loss from the investment to offset your day job. This means you'll be taxed as though you've only earned $45,000 throughout that financial year. Essentially, the $5,000 loss acts as an extra tax deductible on your personal income, and you'll then get the tax refunded on that one. The issue with this is that holding your investment is costing you money to hold. You're only making the tax you would have paid on that amount back. And this really means that the lower your taxable income, the worse your return is. If you're earning under $45,000, you're only getting back between about 19% and 0% in your tax return. On $5,000, that'll be about $950. This means it's actually costing you $4,050 each year just to hold the investment. So not only are you not making money, you're losing it by holding the asset. The more you earn from your day job, however, means the higher your tax bracket is. This means the more tax you'll get back from a negative gearing deduction. With that $5,000 loss, someone in the top tax bracket would get back 47% because that's the top marginal tax rate. This equates to around $2,350. It's still costing them $2,650 to hold that asset, but that's $1,400 less than it is costing someone in a lower tax bracket. Not only does it mean they get a higher return than someone with a lower taxable income, but because they're earning more from their day job, they should theoretically have more disposable income, which means they're able to lose more money in the short term with the hope of one day having longer term returns compared to someone that is living month to month on a much lower income and can't bear to lose that money constantly. So what are the long-term returns that people at negative gear try to achieve? Specifically, that would be higher capital gains. Now, the strategy is not foolproof, it's not perfect, and it does not work for everything. But as a general rule, the returns for assets tend to be about the same. If you assume that all assets earn overall the same return, and the difference between them is the split. How much is capital? How much is income? If you assume that assets grow at a 5% return, you get something with 0% income and 5% growth, or 5% income, no capital growth, or 1% income, 4% growth, etc., etc. You guys get the point. So many variances between them. Now, most people that go for a negative gearing strategy aim for something that is a low income return. Still market rate so that you're allowed to get the full deduction, but that has a really high capital growth. They use this large deduction to offset the tax in the accumulation stage. As I showed before, this works best for those in the highest tax bracket, and then they start selling it down once they have retired. When you sell assets held for over 12 months, you get the 50% capital gains discount. So when these people have retired and they're no longer earning income from the day job, they still have the tax-free threshold. Let's say you're part of a couple, and with a discount, you could potentially have $80,000 in capital gains each year without actually ever having to pay any tax. Now, I love the saying, the market is able to stay irrational longer than you are able to stay solvent. In theory, using a negative gearing strategy might help to build wealth, and is a good tax minimization strategy. However, you really need to be mindful that the strategy is really best for those on really high incomes and have significant discretionary funds. All investing has risks. You need to make sure you understand the consequence of whatever investing strategy that you follow. Hopefully I've been able to give you guys a better understanding of how negative gearing works, the pros, the cons, benefits, and pitfalls. If you have any more questions, please feel free to drop a comment below and I will answer if I can. Thank you so much for watching, and I'll see you guys in the next one.